Okay, so today we're diving deep into Crisil Limited. It's often called, a structural play on India's formalizing economy. And the big question we're tackling is this: is it really a lifetime investment?
That's the core of it.
So the investment idea, it seems, hinges on this very resilient sort of dual-engine business model.
Exactly. And our job today is to really pull apart how that domestic regulatory side kind of hedges against the global research business, which is more discretionary spending. Understanding that balance is key to seeing if that structural growth story holds water.
Right. Let's get into those engines then. First up, the domestic fortress, the ratings business. This is the one driven by regulations, right? Tied to things like corporate bonds, bank loan ratings in India.
Precisely. And the source material highlights how, well, lumpy the revenue can be here.
Yeah, I saw that, ratings grew strongly, what was it, 17.7% in FY24?
Solid growth, yeah.
But then, bam, in Q3 2025, growth just slammed down to 6.6%.
And the reason. A huge drop, nearly 33% in bond issuances. That data point is crucial. It just confirms, that this part of the business is inherently cyclical. When India's credit markets slow down, Crisil feels it. Straight away.
Okay, so it's powerful, but definitely runs hot and cold, like you said. So if that engine has this cyclical drag, how does the whole model get labeled highly resilient? Must be engine two.
That takes us to the global powerhouse, the research and analytics side, the KPO business.
And this is the much bigger piece, right? Around, 75% of the total revenue?
That's about right, yeah. It's the main driver.
But it's driven by discretionary spending from global financial institutions. And well, that showed weakness recently, too. Didn't growth slow right down, like only 1.3% in Q2 2025?
It did. The sources directly blame curtailed discretionary spending by global clients, so that engine has its own vulnerabilities.
So two engines, both seem a bit wobbly lately. Where's the super resilience?
Well, here's where it gets interesting. There's actually a sort of hidden third engine, a captive one. You have to look at their majority owner, S&P Global.
Okay.
Crisil operates something called the Global Analytics Center, the GAC, and it basically functions as an internal KPO just for S&P Global.
So it's work they're guaranteed to get from the parent company.
Exactly. It's a stable, high-margin revenue stream, and crucially, it's completely insulated from those cycles we just talked about, both the Indian credit cycle and the global spending freezes. It's a buffer.
Okay, that makes sense for stability. But what about their competitive edge? How strong is their moat beyond just having this captive business?
Well, you measure that with market share and return metrics. Crisil is seen as the gold standard in India. They've got an estimated 65% market share. That dominance gives them real pricing power, creates a network effect, and the proof really is in the numbers. Look at their return on equity.
It's high, isn't it?
It's exceptional, 40.4%. Compare that to their closest competitors who are down around maybe 21%. It really stands out.
Okay, so strong brand, dominant share, great returns, stable captive business. Yet the sources say it's not a buy-and-forget stock. Suitable for a lifetime portfolio, yes, but needs watching. Why? If the structure's so good, what are the big worries? What keeps it from being just set and forget?
That brings us squarely to the risks. Existential risks, actually. The sources point to two main long-term threats. First, and probably the biggest, is the issuer pays conflict.
Right, the fact that the company being rated is the one paying the rating agency.
Exactly. It's an inherent conflict of interest.
Right.
We saw how badly this can play out during the IL&FS crisis back in 2018. If another major scandal hits, it could genuinely shatter their brand reputation. And worse, it might force regulators to switch to an investor pays model, which would fundamentally change the business.
Okay, that's a big one. What's the second threat? You called it insidious.
Yes, the second one is IRB model adoption, internal ratings-based models. This is more of a slow burn, a long-term threat specifically to the domestic ratings business as the big Indian banks get more sophisticated.
They start using their own internal risk models.
Precisely. They get regulatory approval to use their own models for calculating capital requirements, and the financial incentive is there for them to do it.
Which means they need fewer external ratings from companies like Crisil for their bank loans.
That's the potential impact, yes. It could lead to a structural decline in demand for a core part of Crisil's domestic revenue over the long run.
So, real risks there. Conflict of interest, potential long-term demand erosion.
Definitely real risks. But let's connect it back to the bigger picture. Even with those threats, the baseline forecast, the minimum EPS growth, is still seen as a pretty defensible 12% AGR through 2030.
And what's driving that confidence, despite the risks?
Structural tailwinds, mainly the sheer growth needed in the Indian corporate bond market. It basically needs to more than double by 2030. That provides a fundamental demand floor for ratings.
So the final verdict seems to be yes, it can be a core holding for a lifetime portfolio. But only for investors who are patient, willing to ride out those cyclical air pockets we talked about. And you have to accept that you'll likely always pay a premium valuation for this kind of quality and market leadership.
Absolutely. And maybe one final thought, something to watch closely. The real test of resilience going forward. It might be how well management executes on its recent capital allocation shifts. Specifically, that $38 million they just spent acquiring McKinsey's Crisil business.
What's the goal there?
It's meant to boost their capabilities in wealth management benchmarking globally. It's a strategic bet to accelerate growth in that global engine. So you, as an investor, need to keep an eye on whether that acquisition actually pays off and delivers the intended results. That's key to the next phase.